Okay, morning everybody. On behalf of Storebrand Asset Management, I would like to welcome you to this webinar. We are happy to see that so many clients from Denmark and international clients as well have signed up. My name is Kim Andreasen and I will be your host today. I am heading our newly opened office here in Copenhagen in Denmark. And I work side by side with my colleague, Alan Statakopoulos, who's also with us today. Today you will hear more about one of our most successful strategies, Storebrand Global Solutions. This is an active managed globally equity fund with the SDG as a kind of compass for the stock selection. And based on the performance in the past 5 years, this approach seems to be very successful, not only from a sustainable point of view, but also from an excess return point of view. To do the presentation, we have invited Ripman, who is the lead portfolio manager for the strategy and has been the lead portfolio manager for the strategy since 2015. Philip has worked with Storebrand's sustainability team since 2006. And he has been a key driver for the development of the sustainable area in our company. Philip will introduce himself and his team a bit more in a short while. And before I hand over the word to Philip, I just have two practical informations. This webinar will be recorded and you will receive a link to the recording together with a PDF with Philip's slides after the webinar. We'll have a Q&A session after Philip's presentation. And if you have any questions for Philip, please submit them by using the chat function here in Teams. And with these words, I will hand over the microphone and the screen to you, Philip. We look forward to your presentation.
Thank you, Kim. Lovely to be here. I think there are quite a few familiar faces on the line as well. But for those that I haven't met previously, I'll do a short introduction myself, perhaps, before we jump into the presentation. I've been with Storebrand Asset Management since 2006, which seems like a rather long time now, but it's been a wonderful journey. We've managed to develop sustainability from a beginning point of about the mid-90s to where we are today. And we're happy with the journey and the product offerings that we now have within this space as well. And you know, coming from a sustainability background, it's been an interesting journey for myself as well, coming from a role as an analyst and then moving steadily towards the asset management side. And as Kim mentioned, took over as portfolio manager in 2015. And I think we've had an excellent track record for the strategy at hand today for Global Solutions. So I want to take you on a little bit of a journey through the product. I'll talk a little bit about macros. I'll talk a little bit about drivers, what we're seeing in the market at the moment, a little bit about performance, and we'll dive into perhaps a little bit of the investment process that makes us a little bit perhaps different than others. So with that being said, we'll jump into the presentation. So for those of you that I haven't previously met or talked to you about the fund, these are the 4 themes that we invest in within the framework that Kim mentioned, which are the Sustainable Development Goals. I'll perhaps preface this by saying that the Sustainable Development Goals are important as an investment framework for 2 main reasons. One is that it actually represents a common language, which I think within the sustainability sphere has become very important. There's been a lot of inflation of terms being used, and there's been a lot of different ways of talking about sustainability, and specifically sustainability within asset management. So the Sustainable Development Goals really kind of cement an idea that we are in agreement about which challenges we face. And as long as we are in agreement with these are the challenges at hand, then I also think it's suitable to then say that, well, if these are the challenges at hand, you shouldn't really have to hear about different types of definitions, other than the fact that we now seek to align capital to solve some of these challenges that we agree are the main ones that we are facing today. The second part and the key perhaps part as an investment framework is that they represent capital flows. And I think over the past couple of years and during 2019 and 2020, that's been very evident within the green space, to put it like that. I think we've seen excellent performance within renewables and pretty much any company attached to the idea of a transition to a low carbon economy. So we're seeing some of the potential within some of the segments within this framework already. And what we decided to do once the Sustainable Development Goals came along was to do an analysis of the entire framework and decide on 4 key themes that we felt were true throughout the framework, and that also represented a balance between environmental and social issues. And I think that also is something that gets lost a little bit with the recent focus on green activities, is that there's a social dimension to both, well, to both issues like climate change, but also like the Sustainable Development Goals. So our attempt at then being able to cover all these 4 themes are encapsulated within the 4 themes of climate change, sustainable cities, empowerment, and responsible consumption. And as you can see, the 4 themes are divided into 3 sub-themes. We do have competition in terms of these sub-themes. So for some of them, there are other competing sub-themes that we do track and consider whether or not they do warrant further attention and further analysis as a part of the fund. But at the moment, solar energy, wind energy, grid infrastructure, batteries, I think that's the more obvious part, the very kind of green-centric renewables part. Sustainable cities with water, urban planning, and mobility. Interestingly enough, in the mobility space, we've obviously seen an effect of the pandemic with companies that do transportation, and specifically public transportation, obviously seeing a reduction in passenger volume. I'll return to that a little bit later on. And within responsible consumption area, really a focus on material efficiency and recycling, circular economy, an area where the EU has wanted to and has, in my opinion, taken the lead. And empowerment, as I mentioned, a little bit of a different kind of way to think about social issues. Often, I think in the Nordics, we get, specifically if we think about an issue like gender equality, we think about boards and management level issues. Whereas here, it's really going back to basics from a global perspective and looking at what are the conditions that cause inequality and how do we invest in companies that understand that these are actually challenges that can get solved through products and services within the companies themselves. And that's another key point that I'll pull out at this point and just say that what we're seeking for and what we're looking for in terms of companies here are companies that have products and services that can actually help solve the Sustainable Development Goals. So moving on, I'm lucky enough to have been joined by 2 excellent colleagues in the past year. Fantastic to have additional resources available for the strategy and 2 excellent minds to go into the analysis of these types of companies. Now we do sit in the midst of a lot of financial competency, so being able to draw upon other types of competencies quite necessary when we look at the themes and we look at the topics and types of companies that are at hand. So having a diverse set of backgrounds is always a benefit, in my opinion, as long as we do practice what we call a Darwinistic approach, which really is a best argument wins approach. So I'll run through a tiny bit of the investment process. Like I said, I won't go through the whole thing. We can always set up other meetings if it's of more interest, but I'll pull out a couple of points that I think makes us a little bit different and perhaps start with a very basic idea of, how do we find these types of companies? Now, like I mentioned, we do want companies that through their products and services actually help alleviate or solve some of the Sustainable Development Goals. That is a little bit different than perhaps other asset managers or other research agencies that you might have listened to, where ESG tends to focus a lot on process. So year-on-year improvements, policies, board composition for that matter. And while all of these issues are in and by themselves important, I think it's also important to have a different starting point, which is what does the actual company produce? What kind of goods or services does it produce? And use that as your baseline rather than whatever ESG score a company has. Moving on from that part, I think it's important to say now that one of the new features that we've been integrating over the past year has been an alignment with the EU Sustainable Finance or Taxonomy plans, which we've then said we want our entire database of solution companies to adhere to, which is the substantially contribute, do no harm, and adhere to minimum standards, kind of 3 points that have come out of the taxonomy. Now, obviously, the timeline for the taxonomy is still a little bit up in the air given the recent delay in implementation. And And the way that we are looking at it now is that we would like to be aligned in principle and continue to refine that as time goes by, which we feel we're in a good place to do. And then I think it's important to say in terms of manage expectations that this is also not a fund that is just interested in going into purely into small caps or smaller companies. We do often get the question that, from our investment point of view, shouldn't we in every single holding be 100% aligned with what we want exposure to? And I think the basic answer to that question, if you look at the task at hand and the real challenge that the SDGs represent, is that we need all different types of companies suited for different types of challenges, but that understand and have products and services that do align with solving some of these issues. Now that means that we do have smaller companies, yes, they are attractive, but we would also like to have bigger companies that understand their part in the same type of value chain as well, which we do have as well. So moving on to a little bit just in terms of diversification, and I think this has been key for us over the past 5 years as well, which means, like I mentioned previously, we do have diversification across the SDGs and across the kind of ES and G sphere. We're not primarily just a green fund as such. Like I said, we do want that anchor within social issues as well. I do think social issues in terms of timelines and drivers are possibly a little bit further away than the green companies and kind of the green momentum that we're seeing at the moment. And I'm okay with that to a large extent. And I'm happy to see that the diversification has played dividends into the fund in terms of we're not fully kind of saying we don't go down all the way. If renewables were to go down a little bit, we obviously are diversified out of that area. So in terms of value chains as well, the way that we think about it is quite simply, you have some obvious candidates in terms of companies. To use a specific example, I think most of you are probably familiar with Vestas, given who I'm talking to here today. But the question, once you've identified, obviously Vestas is one of the more traditional solution stocks, because yes, it is what other companies are important in that same value chain that perhaps do not have the same recognition and the same standing as Vestas? Are there companies like we've identified with, a company like TPI Composites that deliver composite materials into the wind blades, or Prysmian that do electric cables connecting the wind farms into the grid itself? And being able to identify these types of companies gives us a level of diversification as well across the portfolio, and we adhere to the same principle regardless of theme. Like I mentioned, in terms of size, I think specifically as we move into the empowerment side as well, what we see is when we're talking about fundamental services and fundamental offerings within the digital space, within healthcare, within financial services, obviously we need companies that can handle infrastructure, and in a lot of cases those will be bigger types of companies. But again, it's important to refer back to the EU taxonomy. We do want to make sure that if we do invest in companies of a larger nature, they do follow the same principles, which are substantially contribute. We don't want the companies to do any harm on the other side, something that would contradict our reason for being in the company in the first place. And we also want them to adhere to those standards that we expect from these types of companies, which Storebrand has a long history of making sure that we are across all portfolios, including this one. And drivers I'll talk a little bit more about as we cross over into the macro themes. So where are we today? And I think it's perhaps a little bit of change of pace to be able to bring some positive news to light, because we are currently in a news cycle that is very dominated by negative news. If it's the election in the US, Supreme Court nominations, fights from a political point of view, and obviously the pandemic are pretty much pervasive now throughout our media picture. But I wanted to raise your attention to a few issues and a few positive points of news. I mean, the California banning sales of new gasoline cars by 2035, California has a tendency to go further and go ahead of the pack, so to speak, from a US perspective. But it does put into play a question of when this might become a reality in other places. Biden and his $2 trillion investment plan, should he be elected, now is obviously going to be a boon for a lot of companies within the space that we do operate within. I'll talk a little bit more about that later on in the presentation. And I think one of the most notable things that has happened over the past time, or two of them, one, China committing to be carbon neutral by 2060. I don't think there's a full realization of the magnitude of that event yet. I think that will dawn on people as time go by, but we are talking a tremendous amount of change going into society as a whole. And obviously different types of companies will be needed to solve some of the issues that we see specifically within China. And then in terms of the EU Parliament, I think it's quite noticeable that the European Commission proposed 55% cuts by 2030 and ended up coming out of the session with a decision to cut 60%. That doesn't often happen. I mean, we don't go into negotiations and come out with a higher number than we went into at the first negotiating stance. So I think that also signals the EU's willingness to lead on these issues, and I think it will play over into other parts of regulation as well. And one of my main views in demonstrating this is really when we talk about the kind of green performance that we've seen within the last couple of years, is that there's so many trends going in this direction at the moment. There's so many regulatory bodies forcing this type of change that I don't think we've quite understood the magnitude of societal change also that will come as a result of this, which leads me to the conclusion that tomorrow won't necessarily be like the past. So moving a little bit on, I think it's important to highlight that it's a reflection of politics in part, and while politics is dominated by short-term issues today, I do think it's important to look at some of the numbers behind this. And what we do see is that people in the EU generally support tougher climate change action, and the same goes for China. Now, the US could be said to be lagging a little bit behind, but we do see the trend increasing in the US as well. And I think this is important while we're in an election cycle to understand that even should Trump win, which doesn't seem likely as we sit here today, but could still be an option, I think it's important to say that, we see the trend in terms of employment, for example. So for every one job within the fossil fuel sector, there are now 3 jobs within, let's call it the green sector or the clean energy sector. And this is important from a cynical point of view as well, that sooner or later, both parties in the US will realize that in order to win votes, they will have to talk to the biggest segment of voters. And today that isn't people working in the fossil fuel industry, it is people working within clean energy. So sooner or later, the parties, both of them, will wake up to this fact and will have to adhere to the fact that that's where most of their voters actually are. And regardless of Trump's plans to revitalize the coal industry, which obviously hasn't found place, he will have to appeal to voters that now work within the clean energy industry. And this is a trend that we've seen increasing over the years and doesn't seem to want to abate anytime soon. And then when we talk about long-term and short-term drivers as a whole, I think it's important to point out that this isn't all just about neither long-term nor short-term drivers. We really see them across the board. Now, we have long-term issues like water scarcity, where we're seeing an increase in the issue across the board, and an increase in understanding that production of thermoelectric electricity requires a lot of cooling water. So actually, by switching fuel source, you can actually alleviate this problem to a larger extent. Digital access obviously has become a key issue now with the pandemic that we can talk a little bit more about as we go on in the presentation. But again, financial access, healthcare access, climate change, these are all trends that will become stronger in time. And I think climate change particularly so, given that the main drivers at the moment, at least in my point of view, has been the fact that we have local air pollution issues first and foremost. I think that's been the key driver in China, for example, where the local populaces have said that this isn't a situation that they can tolerate. And therefore, the government has actually implemented lots of changes, not only when it comes to thermoelectrics, but when it comes to cars and different types of emissions that go into cities. Now, in terms of the short term, I think local pollution issues, like mentioned, I think what we're seeing also is that the market is basically recognizing at least solar PV and wind as the better form of technology, and also the type of technology that has a potential to improve and improve drastically over the next, even 3, 4, 5 years even. Digital solutions, like I mentioned with the pandemic, there has been a focus on this as a whole. I think we're seeing companies, from the financial industry to others, focusing on how they can become more digital overnight. And we're seeing more of that in terms of basic fundamental systems that need to be in place. So access to digital services, access to healthcare is becoming much more digital today, and we already had that as part of the portfolio before the pandemic actually hit. Climate change, like I mentioned, we'll see probably an uptick in attention given to climate change issues, specifically with the delay of the COP meeting to Glasgow next year. I would assume that it would take more front and center stage at that point again, and perhaps the pandemic situation will have changed, giving it more airtime as such. But again, I would say, remember that there's a Paris Agreement here that is ratified in most countries, which means it's not going away, and in fact it will ramp up over time. That's a built-in mechanism of the Paris Agreement. And again, there are just issues that go across time and theme, and we see this across all 4 themes that we invest in terms of health issues, climate change, circular economy, EU sustainable finance, EU green recovery deals. There's so many now trends pushing in this direction that I don't foresee it changing anytime soon, but it is important to point out that it won't be a straight arrow from A to Z in this case. We will see up and downs, but I do think we are seeing monumental change, and that will continue. So just a little bit in terms of performance, we're obviously very happy with where we are. Current September was a very good month for the portfolio as a whole, and October has also been very positive so far. Moving into a little bit of theme attribution, climate change is the theme that has dominated in terms of positive attribution to the fund. In terms of performance, we see that in March, we obviously had a period where the markets went down. And in that case, given that we're slightly more into small caps in the climate change side, and once people were seeking a little bit more liquidity in larger companies, it hurt us a little bit in March. But somewhere there you see the diversification effect with, for example, responsible consumption, which has generally been positive throughout the entire year so far, with a small exception in April, but it has had that diversifying effect specifically in March when renewables went down quite a bit. Sustainable cities also been very positive, and again, when we get to empowerment, is the one that we feel has a little bit more of long-term drivers in it. The communication services sector as a whole has done quite poorly this year, so we do expect to perhaps see a rebound at some point within that sector as well. A little bit in terms of portfolio characteristics. Now, some of this will be evident to a lot of you. Obviously, we are zero weight in energy. That comes from the fact that we are a fossil-free fund. But as you can see with the rest of our exposures, we are quite diversified in terms of having some exposure to most sectors today. Industrials is a heavy overweight. A lot of the green companies come in under industrials, with some coming through utilities as well. But there's a definite overweight there within the renewable and green space. And in terms of regional weights, it's not something that we adhere to in terms of wanting to stay in adherence to benchmark in any sense. We are overweight Europe and underweight North America, and we don't invest in any of the FANG companies. So I think that's also a highlight throughout the years. We've managed to get the outperformance that we have without being invested in any of the FANG companies, which to some extent have led part of that recovery in the US. Just to demonstrate a little bit of a peer analysis that we do to look across the board, how are we doing in comparison to others within this space, and looking specifically here at roughly 1,308 different funds, the kind of cross-cut of these type of global active equity funds, and to see that we have been doing very well really since about 2015 and on. So I'll talk a little bit about the year as a whole perhaps, and just highlight some of the positions that we've had that have gone well and some that haven't. Obviously, you can see the effect of the coronavirus and the pandemic when we enter into the early stages of March. And I really do think that has been a kind of seeking for more liquidity at that point, where small caps have taken a small hit. We managed to avoid going too far down into April, and we've seen a healthy recovery since then. As you can see in the top 5 in terms of companies that have led to negative performance, are positions 3 out of 5 are positions that we don't have, and I don't foresee us at any point really having. But we do have Central Japan Railway and we do have Telefonica in the portfolio. I alluded to earlier that we have some green transport companies, and Central Japan Railway has been an example of this, where we've seen a loss of passenger volume, which obviously then means a loss of income for the company, and the company has been punished as they've released those types of results. which is to be expected. Now we're sitting quite firmly in the boat here with these companies. I do think that once the pandemic settles down and we see an exit point from that, these are companies that will rebound with an increase in passenger volume, which we do expect to see across the board. And I do think from a long-term perspective, if we look at mobility as a topic, we should expect an uptick in use of public transport. It is, at least from a city's perspective, and cities are becoming more and more important in this space, it is becoming, it is the only real way to call transport green in this sense, in terms of its scalability for the solution at hand. Now, in terms of companies that have done well, Sunrun, obviously having bought Vivint, have done very well this year. Even after the purchase of Vivint, we're seeing that they have about a 3% market penetration within the US. This is a company that delivers household solar panels, and Vivint gives them a better access system to be able to do that. And they should be able to take out synergies between the two companies as well, but still a fantastic case to be invested in, given the potential of that within the US as a whole, and really they're only scratching the surface of their potential already. NVIDIA, which is an exciting company, not a traditional company that you perhaps might see in a solution stock context, but are completely essential within one of the value chains that we do have. Autodesk is another example of that value chain, where we have software companies and software solutions that do allow for a reduction in material use through better being able to model for use of different parts for architects, for construction and engineering. And obviously NVIDIA provides some of the hardware that goes into this, but they're becoming a bigger player in terms of issues like artificial intelligence and in terms of both automation and autonomous driving, for example. So an interesting company really from many aspects of the SDGs, but obviously being dominated at the moment with a potential buy of ARM from SoftBank, which, depending on who you read at the moment, has about a 50% chance of going through or not. So we'll see what happens on that front. Other than that, I think some of these are well-known names. Samsung within the battery area, Pattern Energy Group, which got taken off the stock exchange a little bit earlier this year and bought up, which has been a positive holding for us as well within the renewable space. BYD, which operates within both the public transport sector, but also within zero-emission vehicles, and also within buses, that type of aspect, has a very interesting project with SkyRail, which really is a delivery from A to Z within a overland transport, public transport system that has an exciting potential as well. So I thought I'd return then a little bit to the kind of macro questions at hand to talk a little bit about Trump versus Biden. Now, this is very kind of apolitical in terms of wherever you stand on these issues, but obviously Biden has a larger commitment, I would say, to investing in a transition to a low carbon economy, and the areas that he has signaled that he wants to use this $2 trillion US dollars within, we mostly cover today within the portfolio. I think the only area that we still have is a little bit of a question mark from an analysis point of view as well as agriculture, where we've got yet to really identify a lot of solution companies and that are of any sufficient size to be able to invest in from this type of strategy, but is an area that we're keeping our eyes on. And again, all of these issues are really covered today. I think it's important to highlight, even if Biden is invested, it won't be a straight road there. With the potential confirmation of Amy Coney Barrett, we are seeing a potential that could reverse some of the ability of federal agencies and their ability to regulate on climate change issues. So if you look at Massachusetts versus the EPA originally didn't have a mandate to regulate on CO2 emissions. But once it was deemed that CO2 emission posed an immediate health risk for the American people, they were given that mandate through the ruling, which I believe was a 5-4 ruling as well. And with the introduction of several very conservative judges, there is a potential that this could get overturned, and it would actually weaken the federal agency's ability to manage climate change as an issue. And it's important for the reason that if you think about all the issues that Obama managed to address and some of the ones that he didn't, But the ones that he did have success in, specifically issues like the Clean Power Plan, methane emission regulations, they all came via federal agencies. So they do play a very important role in the US economy, and they do play an important role in regulating for climate change. So it won't be a straight arrow, no, regardless, even if Biden is elected. I think it's worth keeping an eye on the potential confirmation of Amy Coney Barrett and any signals that might come out of that, alluding to the role of federal agencies in managing these issues going forward. Now, I don't think it can upend the narrative. I think that's important to say. I think there are other forces that are more important, specifically market forces at hand, that will dominate the sphere of renewables versus fossil fuels, but it has the potential to slow down a potential shift, to put it like that. And I think this is one of the more interesting graphs that I've seen over the years. I think it's become a badly kept secret that a lot of the different agencies that look at modeling for predictions of where costs will come in and what kind of levels of implementation we'll see from renewables have missed year in and year out. And I think the none is more obvious than the IEA, which I do believe I have on the next slide after this. But I think it's important to now start to illustrate the fact that costs have come down to a level which makes it viable nearly across the board. Now, solar and PV and wind aren't the solution to everything. There are intermittency issues. There are issues related to, to what extent the sun shines and the wind blows that we can't just ignore. But I do think in those cases where one could substitute one for the other, it's becoming demonstrably clear that the market is favoring solar, PV and wind. And also what we're seeing is that, and some of the research that I lately read, is that with a doubling of capacity, specifically within solar, we can expect to see a drop in price or a drop in cost of roughly 30 to 40%. So again, we have a potential for even lower costs when it comes to these types of technologies going forward, which should cement their place really from a market decision factor. So here we see the different IEA reports in terms of global solar capacity and its rate of expansion. As you can see here, for every year that they have released reports, they have released reports that have been somewhat positive in terms of the fact that they have said that they will grow, but they have never been on point in terms of estimating where capacity additions will come from and how much capacity additions will come into effect. And this again goes to the point that I think a lot of people are now worried about is, is this it in terms of we've seen this rally behind green stocks, can it continue? And I think one of the issues that I try to raise with a lot of people is if you look at the history here and you look at as many forces that we demonstrated just throughout this presentation, I think it definitely can continue, but again, without it being a straight line. And just an interesting fact to round out the kind of driver discussion that I don't think a lot of people have their eyes on either. But I think as soon as we talk about this within an SDG framework and within the frameworks of, these are countries that are going to be struggling with many problems all at once, water scarcity is becoming an issue across the board. And I've highlighted it for the US here, but again, this is an issue that is true just as much in China as it is in the US. And if you ask any company now operating within certain areas in the US if water will be an issue in the future, the answer is very evidently yes. And for many water intensive industries, a higher proportion of their cost base is now going towards sourcing water or transporting water in order for them to complete their tasks or complete their productions. And what we're seeing is thermoelectrics, so production of electricity through any kind of thermal process, really has a demand of a lot of cooling water. Now, one of the issues then that comes up with this is you need to actually, from an old point of view then for older thermoelectrics, you actually need to place the production of power with access to fresh water to the extent where you have enough to do cooling and that there isn't competition so much so that it drives your cost base up. And in that case, if you look at renewables, we have the potential to actually place renewables in areas that haven't previously had access to power production as such, and we can move production closer to where the power is being used. And that's a tremendous advantage that renewables can utilize over time as well. And I do think if you think about it from a regulatory point of view, through something like this, where you see in several states where agriculture is a significant part of the economy, if you can actually then make sure that we start shifting from thermoelectrics over to renewables and freeing up some of those water resources to be used elsewhere, I think that would come in as a boon for those that were doing politics in that area as well. So it should be an additional driver in time to make sure that we continue pushing towards more renewables. So that's what I had with me today. I hope that gave you some insight into the way that we're thinking around the portfolio in terms of how we're thinking along lines of the SDGs. And yeah, we'll open to any questions.
Thank you, Philip. We haven't received any questions in the chat yet, but please feel free to unmute your microphone if you want to ask a question to Philip.
Hi, Philip. This is Alan. I have actually got two questions. The first one, there's a lot of discussion about impact in our industry, and the question is about how do you think about impact in listed equity? And if I can also raise a second question, since I'm on the line, what about if Trump wins?
Sure. Right. So impact is something that we're being asked more and more about, and I think it is very relevant to bring it up from a couple of different perspectives. I think first and foremost, we have to recognize that private equity has a different type of impact than listed equity in this sense. In private equity, the emphasis would be on the impact of your investment to a larger extent than you would be able to demonstrate within listed equity. Now, I don't think that makes it less important to talk about it from a listed equity point of view, but I do think from a listed equity point of view, it's about investing in companies that have a positive impact. And recognizing that, and in those cases that you can have an impact on the company, if that's through active ownership or dialogue with the company, then absolutely that would be beneficial. But I think the first and foremost point has to be seeking those companies that have a demonstrably positive impact. I'll highlight that with an example. Vodafone owns a company called M-Pesa, which you can actually look this up, and I believe it was published in the Science Journal. That just the introduction of M-Pesa, which is a digital financial platform, has helped lift households out of poverty. And I think they looked at, I want to say Kenya in this sense, if I remember correctly, and I think they estimated that just the introduction of M-Pesa in Kenya had lifted about 2% of households out of poverty. Now, this is the type of impact that we want exposure to, and this is why I think impact is important in defining that type of solution company that we want exposure to, and can help promote a shift in capital to those companies that have that type of positive impact. So I think it's important from that sense, and also given the size of the market, obviously having that type of idea run throughout listed equity would be hugely important. So I think I'll mention one other aspect, and I think this is an interesting one from a kind of small cap, large cap perspective, which is small caps. Obviously, you will have 100% alignment with whatever goal or with whatever solution that you potentially would like exposure to, but larger caps do have the potential for larger impact. And obviously, you have to make sure that that impact is positive as much as you can and as much as the data allows you to. But it does have the potential for more impact in that sense, which is an interesting then dichotomy or trade-off when we talk about small caps and being kind of isolated within the kind of SDG or sustainability sphere versus large caps and the potential that they have to transform society really to some extent. So I think that's an interesting issue to just pay attention to without giving you kind of clear idea of any kind of consolidation within that space. In terms of Trump, so if Trump does get elected, like I said, I think there's a couple of interesting points to point out. One is, if we look at global trade and global supply chains, I think Biden will be more diplomatic in nature. I don't think he'll end the more, let's say, aggressive stance towards China, but I think it will be done behind closed doors to a larger extent than it's done under Trump and the use of Twitter. So I think that can also be very beneficial in terms of calming the markets a little bit, regardless of whether or not they agree on these issues. So I think there'll be a little bit more calm in that sense if Biden is elected than if Trump is elected. I think the dangerous thing also with a re-election of Trump is we don't know to what extent then he will not have to think about the next election. and what that frees him up to be able to do and to be able to act. So I think really then at that point all cards are off the table, but there are limits to what he can actually effectuate. And like I mentioned on the issue of renewables, I think the market is very clear here. And I did say this once it was clear that Trump was going to pull the US out of the Paris Agreement, which is fine, let him do it, because at the end of the day, the economics within renewables are turning out to be superior. They have a potential for improvement going forward, and they solve other issues at the same time. So from a renewables perspective, I don't think it changes much. I do think it'll be interesting to see how the US reacts as a whole in that sense. But that's going a little bit far beyond our current holdings within the portfolio and more from my background, I think, within politics and my curiosity within that space. So I think, like I said, Biden would be more positive in this sense, but I don't think it's a straight line either, with Amy Coney Barrett potentially coming in and a weakening of federal agencies. But luckily, market economics should be on our side when it comes to renewables. That was a bit back and forth, but I hope that answered your question.
Yes, thank you.
Okay, thank you, Philip. Since we haven't received any other questions, I'll just say that please feel free to reach out if any questions pops up. Reach out to either Philip, Alan, or myself. And just a final note here, thank you very much for joining us today, and looking forward to see you again. Bye.
Thank you.